Okay, so today we're going to continue our series of options myths that we're trying to debunk. And today's myth involves the following notion. You will read or hear people say, I bought a call on Facebook because I'm bullish on Facebook, and I financed that call with a put credit spread on Facebook, and therefore the amount I received for the put credit spread was equal to the amount I had to pay for the call, and therefore I own that call for free. All right. Everyone loves free stuff, right, as we can see. But it's a ridiculous concept that misleads people, and we've got to work through why that statement is very, very misleading. Let's just say there are a lot of things for free. For example, I have a ticking time bomb in my hand. I give it to you for free. I'm going to give it to you for free. Now you have something for free, right? It's something for free that could blow you and the rest of the block up. So being free doesn't necessarily mean being without cost, right? So let's take a specific example of this. Here we have a bullish position in Facebook that costs nothing. No cash net was transacted on this entering into this trade. The long call cost as much as the short put credit spread paid, and therefore the net cash outflow on the account is zero. The call costs $4.68. The put credit spread pays you $4.68 in this example. Thus, you own that call for free, right? Well, kinda, just like you own the ticking time bomb for free. But I'm not so sure you'd be that thrilled if I handed you a ticking time bomb. If you look at this chart here, this analyze graph, you'll see the risk graph of this particular transaction. You can see Facebook goes up, that's great. But if Facebook goes down, your loss is not limited to the cost of the call. Your loss is now the worst case scenario on that put credit spread, which happens to be $20,000. So with the call, you could have made a large profit potentially, just the call, if Facebook went up quite a bit. But the worst it would have gotten for you with the call was $4,680 on a 10 lot. But with adding the 10 lot put credit spread in to neutralize the cash flow, which is all you're really doing, you're adding about $15,000 of risk, because a little bit more than $15,000 of risk, because the total risk of the put credit spread would be $20,000. So therefore, you have completely changed the risk reward dynamics of the trade. Now, I am not saying this is a bad trade. I'm not saying that at all. Buying the call and selling the put credit spread is a trade. It has different properties, I guess is the best way to put it. It has different aspects to it. Selling that put credit spread has simply changed the nature of the trade. It's a good trade in some ways, in that if the market rallies, the put credit spread will go up and the call will go up for Facebook. But if the Facebook stock sells off, the put credit spread structure has much more of a devastating potential than just buying the call. So, what's the moral of the story? The moral of the story is you have to look at the full risk-reward picture of every options trade. You can't just look at the cash flow, which is all that narrow statement means. I got that call for free. Well, you did, but you took on 4 to 5 times the amount of risk in doing so. But they don't tell you that when they're bragging about how they own that call for free. They just tell you about the no cash flow part. So therefore, you must look at the full risk-reward trade-off of every options trade in order to size up its implications. Just focusing on the cash flow is extremely foolish and will turn a large fortune into a small fortune. So please be fully aware of the risks of every trade you enter into. Cash flow is a minor factor. The most important factor is the complete risk-reward trade-off of the trade, and you need to analyze that and understand that before you enter into it, or you will one day greatly regret getting into trades like that.